Vikas is ready. Let's connect with him. Good morning, Vikas. How are things?
Hi, good morning from London. Great to be here.
You are ready early morning, all decked up from London.
Oh,
Thank you very
oh,
much for that.
yeah, only for 80 now. I'm ready
Thank,
to go.
thank you very much. Thank you. Appreciate that. So, what is going to be on markets' mind for next few days? Will it be the T of tariff or will it be T of tax cut?
I think a little bit of both. You preempted some of my comments by highlighting the shift in consumption from the government, but then also why this is not just a broad-based reason for a rally for all consumer names. If we take a step back for a moment, there's nothing that we heard on Saturday that diminishes our enthusiasm for the long term for India. When Deepika and I were in the studio with you in September, you made a good point about at that level, it seemed like we were borrowing returns from future years. I thought about that a lot in the intervening time, days and weeks and months. And you were right. We've had a very healthy reset in India, especially in the small and mid cap space. Now, I know there's still some pessimism about valuations there, but we're seeing a lot of dislocations. But now we come to Saturday, and I thought it was a neutral to positive budget overall. And there's a lot of things to like, especially for the consumer sectors. And I do think you're right. The extra few thousand rupees per person is not going to go into consumer staples. That remains a sector that we're underweight. But hotels, airlines, air conditioners, consumer durables, that should see stronger trends in the next few quarters. Now, in the very short term, yes, there will be noise because of what's happening in Washington, D.C., but the Indian story is not going to be dented by that.
Let's get into the nitty-gritties. What was the good and what was the bad in the budget, basis which you're going to take your investment call in India?
So if we do it sector by sector, there's some pessimism, or the market seemed to dislike some of the capex numbers for the infrastructure sector. Now, just like we're not broadly painting the consumer staples as a reason to rally, same thing on the infra side, especially in defense. We thought that the market probably overreacted there on a long-term view. So we still like that sector. It's one that we had added to in the recent dislocation in January. If we come to cement and infra capex that had been bid well in the last 5 years since the 2021 budget, I think that some of the sell-off there was justified. Now, what we did like is the support for two-wheelers implicit, four-wheelers, passenger vehicles in particular. We saw those rally in the very short term. Maybe those were a little bit overdone, but we are positioned well for that. And then you saw the rallies in consumer durables, like Nikunj was highlighting. It's not going to go into biscuits and shampoos and soaps like we might have expected 5, 10, 15 years ago had we had a similar budget. And so we have increased our holdings in companies exposed to slightly higher ticket items like hotels, like airlines, like consumer durables.
Right, interesting. Vikas Bhai, are you less sanguine about the kind of outflows that we've seen from India? And also the bigger question is, what would make the FI outflows actually reverse?
So this is a good question. Now, if you look at the India market cap in aggregate, 5.25 trillion, let's say 5.5 trillion, less than 20% of that now is with FIIs. As we know, there's been a lot made about the domestic inflows. On the latter, on the domestic inflows, retail and mutual funds, that should continue. Perhaps not at the same pace that we saw in the second half of the year on a monthly basis, but the financialization of savings in India, that's a very long-term story that will continue. On the FIIs, it's very easy right now. Maybe today's an exception to buy the US. If you look at aggregate market cap around the world, more than half is in the US now. You look at the tech trends, we've seen the aggregation or the accretion of market cap in the US. It seems to be easier to be selling non-US countries, but that creates opportunities for long-term investors. And I would highlight India as the best example of that. But there are other good examples also. China is a good example that's being sold. Japan is a good example that's being sold. Same thing for South Korea, Southeast Asia. These are some of the biggest markets in the world and among the most liquid. But given the noise and some of the disruptive policies or the unexpected policies coming out of Washington, it's easier to sell non-US markets and buy the US. We view that as opportunities for us.
So, tariffs, Vikas. do you think today's reaction by Asian markets and the way Dow futures are moving, is the market reaction reasonable given that everybody knew that tariffs were coming?
I think it's not surprising. The direction is not surprising. The magnitude probably is surprising to us. If we look at some of the markets that were open earlier today or opened first today, South Korea and Japan, you're seeing the tech sector hit in particular. The noise around semiconductors, around chips is increasing. Pharmaceutical companies are being sold off in Japan. I presume we'll see the same thing in India today for companies that have high level of exposure to the US. None of this is a surprise. This is very well telegraphed. But when markets are already jittery, when you're seeing the dollar strengthen, Asian currencies weaken, it's yet another reason to sell. But the US will be sold off today also, at least early on when the market opens over there. So I agree with you. We shouldn't be surprised that tariffs are now a reality. But the magnitude of the sell-off is going to lead to opportunities. I'm pretty confident of that. We remain fully deployed across all the strategies that we invest in India in particular. And even in Q4, when the market had one of its worst quarters in a few years, we were positioned well. It's a time to be even more selective. We're always selective, but that word comes up a lot. But I think it is very important. People have to do their homework and also take a long-term time horizon. Trying to trade these markets will be very tricky if you're trying to outperform on a daily, weekly, monthly basis. You have to take a long-term view. And when you do that, you see the India story is very much intact. The Asia story is very much intact.
So, because I'm looking at the world and I say, US consumer will have to pay more. I look at Indian consumer will have more to spend. I look at the world and I say, there is a fiscal problem or a debt problem for all major economies, but India, the debt is coming under control. The fiscal deficit is coming under control. And yet foreign institutional investors are selling India. I mean, the historical data, which is macros, internal strength, ability of the economy to grow, all those factors currently are favoring India. Yet foreigners are selling into India. I'm just surprised that why is that happening when everything is looking better in terms of the macros and the big picture argument?
So there are a couple of things. Number one, some FIIs who would have bought in 2021, 22, early 23, before the rally really accelerated, might be taking profits. Also, it is easy when the rupee starts weakening after a period of strength to say that this is going to eat into my dollar-based returns. Also, people look at the valuations. That is also, I would say, more of a bahana than a reason to be selling. Just on valuation for a moment, since we left the studio, when we had our last conversation in September, our team has done a lot more work on why the valuations in India are so high. And we continue to contend that the valuations optically might be high, but India as a market is pricey, it's not expensive. The distinction being that if something is pricey, a security, a sector, a market, implicitly you're overpaying. If something is pricey, you're getting something in return. The ticket size might be high or the multiples might be high, but you're getting something in return. And when you start looking at the data over the last 20 years, the two best performing markets in the world are the US and India, even if you adjust for the rupee weakness. Not coincidentally, these are the two markets in the world that have the highest ROEs on average for companies and the highest number of companies with ROEs of above 20%. Even if you adjust for the cost of equity, India and the US have the highest ROE companies in the world. Second, when you look at it sector by sector and you look at EPS CAGRs over 20 years, Indian companies have the highest EPS CAGRs in the world in all but two sectors that we looked at out of 14 or 15. So yes, the multiples are high, the price might seem high, but it's pricey, not expensive because you're getting a lot in return. And to underscore your point, nothing about that has changed since Saturday. Nothing about that has changed since the latest Trump 2.0 tariffs came out. And so we remain very constructive on India. The FIIs probably will come back in phases. Until then, the domestic bid should be there.
So Vikas, other than the premiumization theme, and you talked about adding more to hotels, where else have you, rejigged your position since we last spoke?
So hospitals, clinical diagnostics, we finally added some exposure there selectively. The good thing about our portfolio and the good thing about the Indian markets is that this is not the same benchmark from 20 years ago when India's market cap was $500 billion, not the $5 trillion, $5.5 trillion that it is today. It was easier to ignore this market back then. You could have bought the top 5 to 7 Delhi and Bombay heavy financial names, consumer staples names, PSU names, hydrocarbon names, and left the rest. Now you have 6,000 listed companies in India. That number has grown by 700 because of the IPOs just in the last 3 years. This should be another strong year for IPOs in number and in value. They'll be bigger this year. So we see a very broad and deep market, which is giving up a lot of opportunities. So to answer your question, higher end expenditures, high end real estate, hotels, airlines, we've grown those exposures. We've broadened out in life sciences and healthcare services. I mentioned hospitals already, but clinical diagnostics also. And we are increasing in defense and some of the infrastructure names also, but again, very selectively. The power and T&D names, which Deepika mentioned back in September, they very aggressively sold off, especially the ones that are sub $5 billion market cap. Many of these names are down 40 to 50% just since December. Now, just because they're down that much doesn't make them buys, but it is worth spending more time on these areas, and we're currently doing that.
Appreciate your time. I just want to go back to that very elementary point now. 2021, the market pivoted back to capex stocks because the government pivoted. They really went on a binge spend in consumption in capex. Now market is again ready to pivot because markets feel, and based on government data, that the government peak capex cycle government cycle has peaked out in terms of the real binge which the government in a sense had followed. What that means for the market, capex, defense, railways, anything and anything which had got to do with build India will take a back seat, and anything and everything which has got to do with consume India, I'll say it again, anything which has got to do with build India will take a back seat. Anything which has got to do with consume India will now come in the front seat. What our viewers should focus on, don't buy some of these capex stocks because they've fallen, and don't wait too long to shift your portfolio partly into some of these so-called consumer, whether it is FMCG, whether it is autos, whether it is low discretionary, whether it is durable. Don't wait too long.